Here is something I could not stop thinking about. This year, some Malaysians opened a letter telling them that their medical insurance premiums was jumping by 40 or 50, even 70% for the same coverage they had the year before. One real and admittedly steep case that was made public went from about 1,500 ringgit a year to over 2,000 ringgit in just 2 years, a 45% jump with nothing changed about the policy. So I did something most people never do. I pulled the actual financial statements of our hospitals and our insurance companies to answer one simple question: who is making all that money? And what I found surprised me. Out of every ringgit that our biggest hospital groups collect, they keep less than 10 cent as actual profit. Less than 10 cent. Your mobile phone company keeps more than that. So if it is not hospitals that are quietly getting rich off your rising bills, then who is? Let's follow the money. First, let us be real about how bad this got, because it's not in our heads. Malaysia's medical inflation rate has been climbing for years. Around 12% in 2022, 12.5% in 2023, and about 15% in 2024. And it is projected at nearly 16% this year. To put that into context, the global average is around 10%. Even across Asia Pacific, where costs already run hot, the regional average is about 14%. So Malaysia is one of the most expensive places in Asia to get sick. Only Singapore, Taiwan, and the Philippines are rising faster. That cost growth is what lands on your premium. When the first big wave of repricing letters went out, the regulator's own numbers showed most increases were under 20%, but almost 1 in 10 policies jumped by more than 40% in a single year. The 45% case I just mentioned was real, but it sat near the top end. It got bad enough that Bank Negara stepped in and capped most increases at 10% a year. So this is real, it's large, and it made a lot of people very angry. The only question is, who should we be angry at? So I pulled the accounts of every general hospital group listed on our stock exchange and put them on one screen. IHH is the giant, the company behind Gleneagles and Pantai, with a network across India and Turkey too. They have around 25.5 billion ringgit revenue and a net margin of around 8%. KPJ, our biggest local network, more than 30 hospitals, have 4.2 billion ringgit in revenue and just over 9% in net margins. Then there's Sunway Healthcare, which only listed in March. They have 2.2 billion and the healthiest of the group at 11.5% net margin. And right at the bottom, TMCU Life, the group behind Thomson Hospital, scraping a 1% margin. So here's your first surprise. That is a thoroughly ordinary margin. Your phone company keeps more for every ringgit. A software firm keeps several times as much. We are talking about life-saving surgery, the least optional purchase on earth, and the profit doesn't seem to be anything special at all. So either hospitals are terrible at keeping all that margin, or something else is eating all that money. The answer is, it's the second one. Now the useful part, and the lesson applies to far more than hospitals. There are two ways to measure how much a hospital makes. The first is net profit, the 8% we just saw. The second is EBITDA, which is basically the cash the business throws off before you subtract the cost of the building, the equipment, and the loans. And on that measure, hospitals look completely different. KPJ, Sunway, IHH, all of them sit around 23 to 25%. So roughly a quarter of the revenue is real operating cash. So why does a 24% business become an 8% business by the time it reaches net profit? There are three main reasons here. One, a hospital is one of the most capital-heavy businesses that exists. It is really a very expensive building filled with very expensive machines that go out of date. All of that has to be paid for and written down year after year, and it eats straight into profit. The second thing is doctors. In most Malaysian private hospitals, the specialists are not employees. They are independent and they bill their own fees. So when you get that bill after surgery, a big chunk of it is the surgeon's fee, and that flows to the doctor, not to the hospital's bottom line. 3, and this is the big one for investors, new hospitals lose money for years. It is called the J-curve. You spend a fortune building the place, then it sits half empty for 3 to 5 years while it fills up. Sunway's brand new hospital in Damansara only broke even at an operating level in August last year, which is still considered pretty fast. And that is why Sunway's profit actually dipped slightly even though its revenue jumped nearly 20%. Growth and profit sometimes fight each other. So the money is not vanishing into some hospital owner's pocket. It is leaking into buildings, machines, doctors, and the slow, painful business of opening new branches. Now hold that thought because it changes everything that comes next. Premiums are up and the hospitals are nearing 8% margins. So then we might consider, maybe it's the insurance companies that are making all that money. So I checked, and the data tells us a more interesting story. Between 2021 and 2023, the amount insurers paid out in medical claims rose by about 56%. Over the same period, the premiums they collected rose by only about 20%. They were paying out far more than they were taking in. On the medical line specifically, the insurers were genuinely losing money. They were not inventing the hikes, they were bleeding. But that was a couple of years ago. So here's the question that completes the puzzle. Are they still losing money? And the answer is no. As whole businesses, the insurers are doing really, really well. Now, the biggest medical insurers in Malaysia, the names that are actually on your card, like Great Eastern, Prudential, AIA, are not listed on our stock exchange. They are Malaysian arms of foreign giants, but their Malaysian accounts are still public, so we can still read them. Allianz Malaysia made nearly R1 billion last year, profit up 24% on a margin of around 15%, nearly double of what the hospitals keep. Prudential's Malaysian arm made a similar amount. Great Eastern and AIA are right up there too. To put that into perspective, KPJ, our single biggest hospital group, made about 400 million ringgit last year. One insurer made well over double that. But here's the honest and crucial catch. Almost all of that profit comes from life insurance and investments, the savings from protection policies, not from your medical card. The medical line specifically was the part that was bleeding. So the insurers are rich, yes, but not because they were raising medical premiums on you. That part, they genuinely lost money on. And after repricing and a sharp drop in claims growth, even that is now healing. There were two things that turned the medical line around. One, they repriced. The heights you felt, that's turning things around for them. The second thing was in 2025, the growth of medical claims suddenly cooled from over 30% a few years ago to about 5% last year. This is the thesis. So here's the uncomfortable shape of this. The insurers were bleeding on medical. They raised your premiums by as much as 70%, and now even that part is recovering. In plain terms, you helped pay to fix it. But to be fair, the repricing genuinely was needed. The pool really was running dry. But notice what did not happen. Nobody fixed the reason why it was bleeding in the first place. And that reason is the most interesting part of the story. It is not a villain, it is the design of the system itself. Think of it as an all-you-can-eat buffet. When you pay for your own meal, you order carefully. But the moment someone else is footing the bill, suddenly everyone wants a lobster and a second plate just to be safe. That is what insurance quietly does to healthcare. When a third party is paying, neither you or the doctor has much reason to hold back. People tend to order more tests, more scans, and go for the newest treatment. Why not when it's all covered? Bank Negara pointed this out too. A big part of the rising cost was not just higher prices, but it was higher usage, people claiming more often. And the hospitals bill in a way that encourages exactly this. It is called fee for service. Every test, every consumable, every item is a separate line on the bill. The model rewards doing more, not doing it cheaper. And the pricing is famously hard to compare because almost nobody publishes what a procedure should cost. So put it together, insurance removes the brakes. Fee-for-service presses the accelerator, and underneath both, real costs are rising anyway. An aging population, a wave of lifestyle diseases, expensive new technology, most of it imported in US dollars, which a weaker ringgit makes pricier. Which is why even after all those painful hikes, medical inflation is projected to climb to nearly 16% this year. The bill got passed around, the disease never got treated. So is there a bright spot where hospitals actually do make great money? Yes, in foreign patients. Medical tourism, someone flying in from Indonesia or China pays full price. No local insurance haggling, often going for the high-value procedures like cancer or cardiac care. Those ones work really well for hospitals. Sunway grew its foreign patient revenue by nearly 40% last year. And 2026 has been declared Malaysia's year of medical tourism. That is the quiet, high-margin growth engine sitting underneath this entire sector. And it is the part investors are really betting on. Which brings us to the question every investor is shouting at the screen. If these hospitals only net 8 to 11% net margin, why are they so expensive on the stock market? Because they really are. IHH and KPJ trade at around 35 times their earnings. And when Sunway listed, it came close to almost 70 times. Investors were paying 70 times earnings for a business that nets around 8 to 11%. Either they know something the rest of us don't, or they really believe in old people getting older. And to be fair, aging is undefeated. But that is the real reason. The market is not paying for this year's thin margin. It is paying for certainty. People will always get sick, the population is aging, so no matter what the economy does, people get older and sick. Insurance coverage keeps deepening, and every new hospital that finally fills up adds a fresh layer of profit. You're not buying a fat margin, you're buying a slow, almost unstoppable tide. So let us go back to the start. Who is making healthcare so expensive in Malaysia? And the honest answer is, after all of it, is that there's no single villain. The hospitals run on ordinary margins. The insurers genuinely were losing money on medical, and they had to claw it back, partly out of our pockets. The real driver is the system itself, the buffet effect plus fee for service plus genuinely rising costs. And here's the part that should actually bother us, because our premium did not jump because someone got greedy. It jumped because the medical pool was bleeding, and the only lever anyone pulled was to charge us more. The disease is the system quietly rewarding spending, and that was completely untreated, which is why sometimes we should expect more ladders. So what can we do now? A few things. We can look at co-payment plans where we cover a small slice of each bill. They usually come with lower premiums, and because you feel a little of the cost, they push back against that buffet effect. Bank Negara also forced insurers to offer cheaper alternative plans you can switch into without new underwriting. So it is worth a phone call, and a standardized basic medical plan is being rolled out over the next year or two. The bigger fix is a payment model called DRG, coming in 2027, where hospitals get paid a fixed fee per diagnosis instead of of charging item by item. It aims straight at the accelerator. Whether it works or not is a video for another day. I'm curious what you think. When you get a medical bill, who do you instinctively blame? Drop it in the comments. And if you like this video and want more like it, click subscribe.